Good morning, everybody, and welcome to Cushman Wakefield's latest webinar on capital markets. My name's Anna Town, and I'm based down here in Sydney. I look after business development services for Cushman Wakefield, and it's my very great pleasure to welcome everybody to our webinar right around the Asia Pacific region and indeed around the world. This is the second time we've done a webinar on capital markets and focusing on Greater China. Last time we looked at outbound Chinese capital and their investment intentions. So if you missed that one, make sure you go to our website, cushmanwakefield.com, and you can download a report on outbound investment intentions of mainland Chinese capital. But this time we're taking a focus domestically on China and their real estate markets. And I think it's a really appropriate or timely point to examine China's real estate markets in detail as China begins to open up for business. And it'll be really interesting to hear what has been the impact of COVID-19 and how deep that impact will be on the local markets. We're going to look all around Greater China. We're going to have a spotlight on Hong Kong, which has been in the global headlines for much of the past 12 months, and we'll share our view on this iconic investment destination. So if we go to the next slide, I'll show you what's in store for this webinar. We have presentations for around 30 minutes, and then we've allowed a lot of time for questions from all of you on the call. So you'll be able to submit your questions in the top right-hand box where there's a little question mark, and we'll endeavour to get through as many questions to our panel of experts. If we don't, we will form a view on those questions and send a response out to everybody on the webinar. So in terms of introducing our speakers, we're going to start off with James Shepherd, who's the Head of Research for Cushman Wakefield in Greater China. And he's going to look at some of the key trends driving the real estate markets, as I mentioned, the impact of COVID-19, and look at other macroeconomic trends and the implications for real estate. He's going to look at supply and demand fundamentals. He's going to give us our insights on how landlords and tenants are navigating those conversations around rental reductions and concessions, which is very much part of the conversation at the moment. And then he's going to spend some time on investment volumes and look at trends in the first quarter of this year and where capital has been making investments across the Chinese markets. Following that, Reid Hatcher, who is our Head of Research in Hong Kong, is, as I said, going to take a deep dive into the Hong Kong market. He's going to look across multiple asset classes. We're going to spend time on office, retail, industrial, and the hotel sector. And he's going to give us the view on the outlook for this important market and look at some of the trends also that exist in that market. Look at co-working, office demand, the outlook for rental growth or rental decline, as the case may be. And then we're going to move into a Q&A session. We've got a great panel of experts on the Greater China market for you today. Catherine Chen, who's the Director of Research in Greater China, will lead us through this Q&A session, so don't forget to put your questions in for Catherine to direct. And we've got a bit of, we've got the dream team really together. We have Francis Lee, who's the International Director and Head of Capital Markets for Greater China, Alvin Yip, the President and Head of Capital Markets for Mainland China, and Gordon Marsden, who's a Regional Director of Capital Markets. And what these three gentlemen will do is give you the latest intelligence around investor sentiment, transaction activity, and some of the nuances between trends that we're seeing in domestic and foreign capital in the Greater China markets. And I'm really looking forward to hearing insights from this team, who have been named as the leading capital markets team in Greater China very recently at the Asia Pacific Property Awards. So with that introduction, I'd like to hand over to James to kick off the presentation.
Thanks, Anna, and thanks to so many of you for dialing in. Our chief economist, Kevin Thorpe, has pointed out in recent weeks that containment of the pandemic is the only firm foundation for a recovery in the economy and, by extension, the real estate leasing and capital markets activity. So the good news is that China now appears to have achieved this containment and has hit an inflection point, as evidenced by the PMI reading in red on the left side of the screen, as people are returning to work across China. On the right, Oxford Economics are now forecasting a return to growth in Q3 of 2020. In the mainland, there will be a further spike in activity in Q1 2021 as global headwinds ease, further boosting the China recovery. At the same time, these forces are anticipated to kickstart a delayed return to growth in the Hong Kong economy, which, to be fair, has had a multitude of additional challenges to contend with of late. Next slide. The prevailing challenge has been met with an impressive stimulus response globally. China itself deployed 1.7 trillion renminbi into the financial system, and additionally, many local governments drove local consumption initiatives. The downside to this is the impact it will have on debt. The latest 2019 debt figures released this week show that as the economy started to experience headwinds, the Chinese government responded quickly to relax previously tight debt controls. When the Q1 data comes in, it seems inevitable that this trajectory will continue and possibly even accelerate through Q1 this year. Looking to the future, over the midterm and given past performance, when economic growth returns to a sufficient extent, it seems likely that the government will take another look at debt. In my experience in China over the last 20 years, these periods of tightened lending have created excellent windows of opportunity for foreign investors and banks active in the real estate sector. We should therefore witness an extended window of opportunity from this point forward through 2021 for such groups. Next page. Globally, lockdown responses will have a major impact on future office supply levels over the short term. For mainland China, the chart on the left shows real estate investment volume growth rate, which in mainland China is linked very closely to construction expenditure. Following a tough clampdown on debt to the real estate sector in recent years, construction activity was reweighting to the residential sector in light blue, while office in dark blue and particularly retail in grey were seeing lower levels of expenditure. During this period, it became apparent that local developers were more inclined to focus any dry powder on product that would generate more immediate cash flow. Strata-titled residential property fits this bill. We can also see a sharp contraction of this expenditure in February's investment figures as construction projects were put on hold across the mainland. As activity returns, we anticipate that the residential sector will again take priority, and given many office and retail projects have now been put on ice, it may take some time for these to restart. Some may even be mothballed. In the middle chart, we can see the absolute amount invested in the office sector, down sharply in 2018 and 19 versus prior years, while on the right, you can see developers' proposed China pipelines over the next 5 years. Assuming that construction costs remain constant and a development period of, say, 3 years, these two charts don't tally. How is it possible for developers to build more supply than in previous years while spending less on construction? As a result of these factors, we're likely to see delays in completions and moderation of future office supply. No surprise then that already in Shanghai, 50% of office projects were delayed through Q1. This softening of supply pipeline should be good news for investor appetite, as this potential surge of office property was a major investor concern through 2019. Average annual supply figures over the next 3 years are more likely to be closer to half of what developers are currently forecasting. That's the good news. Next page. The bad news is that the impact of COVID-19 has caused net absorption to dip into negative territory in Q1, and activity has all but stalled as it did during the global financial crisis, as can be seen in Q1 of 2009 in this chart. However, with people now back at work, we do anticipate activity to resume in Q2, albeit on more modest levels than in recent years, given the prevailing global economic outlook. Looking further ahead to Q1 2021, we currently anticipate leasing activity to broadly follow the economic projections I set out at the start of this presentation. Even during recent months, there were still sectors which have and will continue to perform comparatively well in China. These included technology, media, telecommunications, healthcare, finance, insurance, and retail, where there was a strong online offering. Over the short term, we anticipate that the softer economic outlook will stimulate consolidation of business units under one roof to generate cost savings, potentially to lower cost decentralized areas. This was already a trend towards the end of 2019 when the economic outlook appeared to be softening. Next page. So in terms of affordability, this chart on the page shows the top 10 most expensive markets globally. Hong Kong fell 4 places in 2019, as many other markets across China experienced more significant downgrades in their ranking. With a rental decline forecast in the range of 10 to 15% this year, it's possible that the Hong Kong may drop further down this list in 2020. The overall rental growth across China has indeed been modest in recent years. The weighting of new office supply to lower cost decentralized areas has been a major influence in supporting improved rental affordability in comparison to other global destinations. This, coupled with low levels of building obsolescence and excellent infrastructure, bodes well for attracting and retaining occupiers in the markets over the mid to long term. These core cities on the right are just the tip of the iceberg, with many other much more cost-effective markets once you enter China's Tier 2 cities. Next page. On this chart, we can clearly see the rental levels respond during the global financial crisis. Hong Kong and Shanghai were most acutely impacted with rental declines exceeding 40%. Other markets across China sustained more limited damage, and in particular, China's Tier 2 rental levels saw minimal adjustments. A strong rebound was experienced in Hong Kong as rental levels recovered relatively quickly to pre-financial crisis levels, up 76% from their lows. In Shanghai, a more modest recovery was staged, up 30% from the lows. It should be noted that strong rental growth here was hampered by a deluge of stock starting to emerge in Shanghai's lower cost decentralized office areas. In contrast, Beijing seemed to take the global financial crisis in its stride as rentals only softened slightly before not only a recovery, but an acceleration, up by 95% after the crisis. As we look to the future, further rental declines are still on the immediate horizon, but as supply pipelines cool off and leasing activity returns, there will be attractive opportunities in China's first-tier office market. Next page. This chart shows office supply pipelines by market over the next 4 years. The red dots show the percentage that these represent in comparison to existing office stock. We have not factored in the likely construction delays discussed earlier, so these represent a worst-case scenario. We have ordered them by highest to lowest pipeline in comparison to existing stock, with Shenzhen having the highest and Hong Kong the lowest. Guangzhou comes in as the second highest Tier 1 city at 66%, not ideal. However, given the current low rental base, more affordable cost per square meter rate, the fact this market has the lowest current vacancy in China of 5%, strong demand for tenants to upgrade from older Guangzhou office environments to modern buildings, and massive opportunities created by the Greater Bay Area infrastructure push, this market is likely to prove highly attractive to investors. Beijing and Shanghai come in with a more modest ratio of around 50%. Bear in mind these markets also include major decentralized areas. Many international investors have historically struggled to deploy capital in Beijing and in high-profile localities of Shanghai, such as Lujiazui, Jing'an, Tangning, and Shijiahui. Recent turmoil may lead to more opportunity to participate in such highly sought-after markets. Next slide. On the downside, vacancy was already peaking in Q4 2019, and in Q1 saw this accelerate sharply in Shenzhen, Shanghai, and Hong Kong. On the back of the massive Shanghai development area, Shenzhen vacancy hit an unenviable 25%. This vacancy, coupled with huge supply pipeline and comparatively high average rental levels, will likely prove a hard sell to investment committees. However, for owner-occupiers looking to benefit from the Greater Bay Area initiative, and particularly those in online retail, technology, financial services, and healthcare, a buying opportunity may well be on the horizon in this dynamic city. Next slide. On the left, we note that investment volume in 2019 was relatively evenly dispersed across first-tier markets. Guangzhou activity was lower than most due to a lack of solid on-market investable opportunity and the simple fact that lower pricing results in lower total transaction volume. On the right, we can see how office and retail sectors still remain a very attractive sector. In Q1, Shanghai and Beijing have stood out from transaction activity on the back of deals negotiated prior to COVID-19 related disruption. Next page. Due to travel restrictions and economic uncertainty, we do not expect to see any significant transaction volume to be recorded in China until Q4 2020. At that point, it's likely to be a story of extremes, with investors either closing in on well-leased stabilized office assets in prime locations, or alternatively taking much higher risk where there is a heavy discount due to an element of distress, or where lease-up risk has a significant impact on pricing. Retail and hotel assets will be of interest where there's a repositioning angle, and of course logistics will see huge interest where such opportunities do come to market. There is the perception that pricing will soften. If our experience during the global financial crisis is anything to go by, then this downwards adjustment will be modest at best, except where there is an element of distressed, forced sale, or where the lease-up risk is high. For core stabilized assets, major discounts appear very unlikely, but importantly, this may be an opportunity for some investors who have been waiting to acquire assets in highly sought-after locations. Next slide. In mid-February, as China wrestled to get the pandemic under control and the COVID challenge was somewhat acute to China, we ran a sentiment survey of 122 investors. At that time, 99% stated that they would continue to invest in mainland China in spite of the current uncertainties. Nearly 90% of respondents said that their investment budget would remain largely the same as in 2019 or increase significantly. Though most foreign-funded enterprises had significantly slowed project progress, the disruption caused by this event was largely viewed as creating a buying opportunity at that time. The takeaway from all of this: though investor preferences are being tweaked by sector or deal profile, this is not having a major impact on the investor's appetite for the China market. Now let's take a deeper dive into Hong Kong, given the extended period and number of challenges this market has had to face. Over to you, Reid, to give us more insight and update us on the current situation in Hong Kong.
Thank you, Jamie. So to start, it's worth bearing in mind that Hong Kong began 2020 at a very different place compared to other regional markets. Even before the COVID-19 outbreak, months of social unrest and US-China trade tensions last year had definitely taken their toll on the local economy. GDP was already forecast to contract by 1.3% for the year, and business confidence as measured by PMI had just a few months earlier hit its lowest level since SARS. Monthly visitor arrivals were down by half, with hotel occupancies down sharply and retail sales seeing one of the steepest drops on record. Next slide. So flash forward a few months, and with the COVID-19 outbreak and containment measures hitting many of the same sectors, the impact on Hong Kong's economy has been amplified. In the latest revised forecast, GDP is now set to contract by 6% this year. PMI hit an all-time low in February, and as we've seen across the region, tourism has dried up, dealing another blow to the city's struggling retail and hotel sectors. Now, while forecasts continue to point to a long road to recovery, there are reasons for cautious optimism. With Hong Kong now having gone more than 2 weeks without any new local cases, the government is beginning to slowly dial back some containment measures, and that should support local business. At the same time, stimulus funding announced earlier should begin to make its way to businesses in coming weeks. Next slide, please. As Hong Kong's economy has slowed, demand for office space has weakened considerably in recent quarters. With signs of some occupiers downsizing late last year, net absorption in 2019 was down 80% from the previous year. And that trend has continued in Q1, with the market recording negative absorption of around 500,000 square feet, the worst quarterly performance in 18 years. Amongst the sectors we've seen most impacted in the past quarter have been co-working, finance, and insurance. And in terms of submarkets, while negative absorption was seen across the board in Q1, it's the core markets such as Central and Wan Chai Causeway Bay that are coming under the most pressure as occupiers look to save costs by either consolidating or relocating to non-core markets where rentals can be less than half. So as a result, availability in the quarter climbed to a 10-year high of around 10% overall. Next slide, please. By far, the biggest contributor to the negative absorption we saw in Q1 was the co-working sector. Through 2018 and 19, both international and mainland Chinese players expanded aggressively in Hong Kong. Indeed, we saw the same trend playing out in major mainland cities. With a number of leases in the past year being signed at peak rentals in grade A buildings, though, some have found themselves caught out in the downturn with only short-term licensing commitments. In Hong Kong, there were 4 closures in Q1, amounting to just under 200,000 square feet being returned to the market. We do see the co-working sector undergoing a period of consolidation, and in the aftermath of COVID-19, operators offering open plan options may face challenges. However, with occupiers unlikely to want to commit to major capital expenditures, it should be noted that more sophisticated enterprise solutions, where fit-out costs are part of monthly rental payments, will be highly attractive during these times of uncertainty. And this may play well to major local developers to potentially offer some of these solutions. Next slide, please. Mainland Chinese firms have been a key demand driver in past years and a key factor in driving rentals in Central to new highs. Since the second half of 2018, we've seen a sharp slowdown in that demand as many Chinese firms have faced constraints on capital outflows and more recently have weathered a slowing economy. The COVID-19 outbreak is likely to continue that trend as mainland China's economy suffers a sharp slowdown. In this environment, we don't see a return to the expansive growth of recent years in the near term. That said, we do see appetite by some mainland firms with long-term strategies to take advantage of the current downturn, to seek out opportunities to acquire property for owner occupation. This also dovetails with the government's plans to develop the Greater Bay Area. And perhaps illustrative of this, we saw last week Ping An taking a 30% stake in Sun Kai's West Kowloon commercial project that they've indicated will be used as their Hong Kong headquarters. And in general, the Chinese government tends to be more relaxed about such outbound investments that involve a self-use component. Next slide, please. In view of COVID-19 and downgraded economic forecasts for the year, we have revised our own office forecasts in the past quarter for 2020. Based on those, we see net absorption remaining in negative territory for this year and remaining relatively weak next year. But on a positive note, the current downturn has coincided with a period of extremely limited new supply, both this year and next. Nonetheless, availability is expected to remain in double digits, hovering just above 10%. Longer term, however, a surge of new supply is set to hit the market in 2022. And while demand is expected to rebound, availability is set to increase to 13%. Many of the new buildings set to enter the market in that year, though, are expected to be extremely high quality. With much of Hong Kong's existing office stock quite aged and new sensitivities around quality in the post-COVID era, I think many landlords will be looking to include the latest health features, and those buildings should be positioned quite strongly. Next slide, please. With demand set to remain extremely weak this year, we see rentals coming under intense pressure and to fall sharply across all submarkets. The core areas will continue to be the hardest hit, with rents in Greater Central expected to fall by between 15 and 20%. But even in non-core markets like Hong Kong East, which have performed relatively well in recent years, rentals are forecast to come down by 3 to 8%. Next slide. And we see that trend continuing over 2021 and 2022, although at a slower pace, as competition heats up around supply coming out in 2022. So looking at low mid-single digit declines across most submarkets over the 2-year period. Next slide. Turning to retail, the sector has clearly been the hardest hit by the COVID-19 outbreak, as tourism arrivals have dwindled in recent months. But unlike in other cities around the world that are going through this now, the slowdown in visitor arrivals in Hong Kong started much earlier in the second half of last year as a result of local social unrest. With mainland visitors a major driver of sales, much more so than in 2003 during the SARS period, the drop-off in arrivals has been extremely painful to retailers, with a growing number seen to be closing outlets in recent months. Overall, sales have come down by over 50% since January 2019, and after a brief rebound at the end of last year, have plummeted again by 40% since January. Next slide, please. With the prolonged decline in retail sales, street front rentals have come down sharply, especially in core areas most dependent on tourist traffic. In the first quarter, rentals fell by between 15 and 20% quarter on quarter, with rents in most submarkets now down between 60 and 70% from their peak in the middle of last year. Community retail areas like Yuen Long have fared a bit better given their focus on local demand, but rentals there have still come down by around 10% in the quarter. Current forecasts are now for rentals in the core areas to come down by a total of 30 to 40% in the first half, with a gradual recovery beginning in the second half of the year. For shopping mall owners, we are approaching results season for those with a March 31st year end. Accordingly, while it's too soon to know for sure, we expect we may see shopping malls that perform slightly better than street front shops. Next slide, please. Investment into commercial property fell to a historic low in Q1 as COVID-19 and related containment measures halted deals. But deal volumes have been weak for much of the past year and well off the levels we saw in 2017 and 18, as first the US-China trade war and then the social unrest weakened investor sentiment. Other key contributing factors to the slowdown has been an extremely low interest rate environment and the view that the downturn is event-driven and therefore ultimately will be short-lived. With many of the major landlords cash-rich, there hasn't been a lot of pressure to sell yet, and in most cases, there remains a substantial price gap in expectations. While investment into all sectors has come down recently, industrial, by comparison, has held up relatively well and has accounted for the largest share of investment in recent quarters. There are a couple of reasons for this. One is the relatively lower investment sums required, but another key factor has been the government's industrial revitalization scheme, which allows buyers to apply for conversion of use of older industrial properties and secure an additional 20% plot ratio. As a result, we've seen a number of instances of investors purchasing industrial properties for conversion to other uses in recent quarters. Next slide. So there's a lot of detail on this slide and I won't go through it all, but everyone joining this call will be receiving a copy of the presentation. I'll just draw attention to a few key points. Generally, we are seeing capital values come down across asset classes, though, as I mentioned, there haven't been very many transactions in Q1. As a result, yields are softening for office property now in the range of 2.6 to 3.2%, which is up from around 2 to 2.1% a year ago. And with interest rates having come down to near historic lows, we have seen spreads begin to widen. And if we compare to where spreads got to during the GFC, there is perhaps opportunity for yields to soften a bit further in coming months. But I'll let Francis, Alvin, and Gordon comment further on that. So that brings me to the end of my presentation, and I'll now hand over to Catherine for the Q&A. Thank you.
Thank you, Reid. Now I'd like to open the floor to our audience to ask questions. I've already seen many questions being asked during our presentation. If you haven't done so, please click on the Q&A icon on the top right-hand corner of your window to submit your questions. Now I'd like to ask the first question to Francis. In our investor intention survey, as mentioned by Jamie earlier, we saw that the investor interest in the mainland China markets remains fairly strong. Has this strong investor sentiment translated into actions yet? What's your experience with recent transactions in both mainland China and the Hong Kong markets?
Thank you, Kathleen, and thank you for the question. Yes, it's good to see that investment sentiment for China is good, but due to the fact that COVID-19 is hitting the market in Q1, so the cities are locked down, travel between the cities is not allowed, so we don't yet to see a lot of transaction coming in. But for example, like Reid mentioned earlier, in Hong Kong back in the last year, in the first quarter, for the first half year, we have a good market. We have something like US dollar 3.5 billion transaction recorded in H1, but in the second half of last year, Hong Kong has slowed down due to not just the market, but also the social unrest. So we only have a record of 1 billion US transactions. So market has come down something like 70% already. But the good thing is that we did see activity slowly coming back in China, especially in March, in the early part of April. So we are quite confident that in the second half of this year, we shall see a much better and stronger rebound in terms of activity in China. But still, Hong Kong, we don't think the market will come back pretty quickly. On the one hand, it's due to the fact that the social unrest is still there, and also that, as Reid mentioned earlier, the owner investor are quite liquid, quite cash healthy, so they can hold strong on the investment properties. And the price gap there is still quite substantial, like say 15–20%. So it's not easy to crack any major deal in the next say few months in Hong Kong. Thank you.
Thank you, Francis. The next question I'd like to ask Gordon. What's your experience with international investors in the APAC region? Is Greater China still one of the most favored markets? And who are actively seeking assets? Do you see any new market entrants?
Thank you very much, Catherine, and good morning to those in Asia, and hello to those elsewhere around the world. 4 questions in one there. The overriding message, of course, is that APAC has strong fundamentals. 14 major economies, with 3 of those representing over 40% of the global population, namely China, India, Indonesia. So while COVID-19 obviously overshadows the region at the moment, the outlook for GDP and growth looks really positive for many of these APAC countries compared to their global peers. And so in overall job terms, India is actually going to lead the way in the next 10 years, but in the service sector, it will actually be China. And just to give an example, a single market like Beijing is expected to add 1.4 million jobs between 2020 and 2030. So frankly, whatever new working styles kind of emerge from COVID-19, these job numbers are clearly a driver for office net absorption. And accordingly, it's no real surprise that some 50% of all APAC capital markets activity is concentrated at the office sector. If you look at the consumer markets, whether delivered online or offline, or indeed a hybrid thereof, it reveals growth, but more nuanced. The average household disposable income and total retail sort of sales growth show very different pictures sort of country to country, and so more nuanced in how you approach this, but the backdrop is again one of good growth. These strong growth fundamentals are attracting investors to increase their allocations to the Asia Pacific capital markets. 78% of an ANREV survey respondents said as much, which is also mirroring what we see on the ground. And according to our sort of RCA, 10 years ago, the size of the APAC capital markets universe was something in the order of $100 billion US. Today, it's 160 billion. Just to sort of show the growth, of which 30% of that is contributed by Greater China. And if you include land, Greater China represents something like 70% of the overall volume. So in answer to the second part of your question on whether China is still favourite, it most certainly is. Who is actively seeking a new entrance? I think we'll get into this a little bit later, but in brief, it remains a diverse group, and through various routes. We've just seen an entity level transaction, CDL, with Sincere. We've seen fund managers collaborating with operating partners, such as the recent announcement of the tie-up between JP Morgan and Newies in the logistics sector. And let's not forget also those sovereign wealth funds and institutions like GIC who've been active regionally, including in Greater China over the COVID period. I'll pause there, but if time allows, we can always come back later on.
Thank you, Gordon. I'd like to ask the next question to Alvin. Could you talk more specifically on capital flows into China? What's the competitive landscape like in mainland China today? For example, are foreign investors facing stiff competition from local investors or owner-occupiers, as mentioned by Francis earlier?
Thank you, Kathleen. Last year, in 2019, the total transaction volume of investment properties in mainland China was around RMB 290 billion. Foreign capitals accounts for 28% of the transaction volume. Shanghai has been the most popular city for foreign investors, accounting for 48% of the transaction volume in Shanghai last year. We saw some changes in the composition of foreign investors in last year. Although real estate funds are the dominant foreign investor, LP and insurance companies are also jumping over GPs to invest assets directly. Generally speaking, foreign buyers have the competitive advantages of better asset management, discretionary funding, and longer investment periods. As long as RMB remains stable, I believe foreign investors can still compete with their domestic counterparts.
Thank you very much, Alvin. So I'll ask the next question back to Francis. So how healthy do you think the mainland China and the Hong Kong capital markets are at this time? Do you see investors targeting distressed assets? And at the extreme, are there any pressures towards a fire sale situation?
Although I do say that there's a lot of fire sales, distressed asset, because especially the situation in Hong Kong, I think liquidity is high, loan to asset ratio is low, interest rate is low, and the Hong Kong owner investor learned experience from SARS during 2003 and also the global financial crisis in 2008, that the market rebounded quickly within a few months. So I would say in Hong Kong, there's no sort of panic sale. But of course, some investors who are heavily invested in the past few years would like to sell down a few assets for both for cash and for profit taking, rather than selling at a loss. And versus the situation in China is that liquidity is still tight because bank is still taking the policy of not lending a lot into the property sectors, and also taking the government's advice that property is for living, property is not for speculations. So even for some of the developer who have an offshore platform listed in Hong Kong, they can raise US denominated loans, but the government say that new loans only can have to be replaced old loans. They can't have to put into investing into new projects. So liquidity in China as a whole is tight. But I still say that it's not much sort of fire sales, distressed asset situation. Even there's a few, but I would say it's difficult for foreign investors to participate in that sort of market because the process and the procedures are quite complicated for the foreign investor to partake in this sort of market.
I see another follow-up question on the screen. So why do you think the landlords are, do you think they are being overly optimistic about the current situation? And why do you think they're still tightly holding the assets and not consider giving out any price discounts?
As I mentioned earlier, the liquidity in Hong Kong is very high, and the loan to asset ratio for some typically in Hong Kong, especially those listed companies, I think the loan ratio is anything like 10-20%. And also interest environment is low, as Reid mentioned earlier, that is only a 1 to 2 or 2 to 3% interest borrowing rate. So the holding power is very strong. So long as they can serve the loan, I think the bank is not willing to take drastic actions to recover the asset from the owners, but only taking an advisory like some of those highly exposed investors, okay, they sell down a few pieces. So I think market transaction is still there, but it's not in a sort of panic, especially I mentioned earlier that the experience from SARS, experience from the financial crisis, the Hong Kong market will rebound quickly. So it's no point for them to sell down substantially different, for example, like a dip discount of 20-30%, but in a few months look back, oh, I've been selling too low. So I think people are still holding the decision to make any panic sales.
Thank you very much, Francis. So more questions on the impact of COVID-19. So I'll ask Alvin this question. How serious do you think this pandemic is having an impact on both the mainland China, Hong Kong real estate market? And when could we expect a turnaround?
Okay. In mainland China, new investment activities has been postponed due to the lockdown situation. Transaction in the first quarter cannot reflect the true market sentiments because of the time lag effect. Some deals were negotiated or SPA were signed last year but completed in this year. Nevertheless, local investors and some foreign investors who have local offices in China have started to look for opportunities since March. I believe third quarter transaction volume will demonstrate a U-shaped rebound from the second quarter. For Hong Kong, the political disputes remain unsolved since last year. Market sentiments will not gradually change after the pandemic situation is concluded. We can expect that transaction volume in Hong Kong will remain at a low level if social unrest continues into the year.
And a follow-up question for Alvin. Have you seen yield adjustments in the projects you have been involved with or working on right now?
Yeah, since leasing risk will increase and rental levels may decrease in the short term, investors now expect a higher cap rate. However, I think a rise in cap rate will be temporary. In the long run, I expect to see yield compression as global new money supply will create asset price inflation.
Thank you, Alvin. And next question I'd like to ask Gordon. So given the property trends mentioned by Alvin earlier, would you have any examples of the deals you are working on now that illustrate the recent changes in demand as a result of COVID-19?
Thank you, Catherine. I see a couple of questions coming through on sort of alternatives, so maybe we can pick up on some of that later on. So I'll sort of stick to the mainstream, so sort of logistics and retail. And in both instances for investors, and this is building on what Alvin's just said, it's about understanding the underlying occupational market, so the demand in that sense. And obviously now and in the near term, we're having to deal with rental concessions, rent abatement, and simply non-payers of rent. So determining how this is impacting your income or your NOI. I think looking ahead, sort of the end of June valuations will be interesting, potentially challenging in a way that sort of the end of March valuations kind of weren't, because we really hadn't sort of seen a great deal of movement at that point. And then the second aspect for owners at the moment is obviously about directing the available cash and resources to where it's most needed. While we've seen some sort of SOEs, for example, in the office sector, giving away 100% sort of rent concessions for a month or more, and this was something that was outlined in one of our response documents on COVID-19, and especially to those tenants in the sort of tech and business park environments. what I sort of see and hear in the retail arena, and certainly amongst international owners, is this has become very quickly targeted. So who do you want long term in your space, in your mall? Who do you want to support and see survive and prosper? And while some aspects of the logistics arena will clearly be buzzing, I was looking at some data on the Chengdu and Sichuan market, and just to put some contrasts here. So the rental for the general logistics market in Sichuan is at RMB 27 per square meter per month, and the vacancy rate is upwards of 25%. In the cold storage arena in Chengdu, you've got rents 3 times that level at sort of 95 RMB per square meter, and vacancy only at 3%. So we do need to sort of pick up on these sort of nuances, and they sort of surface pretty quickly. We're actually running a mandate that includes shopping malls at the moment that range from sort of community malls to those that have more of a bias towards tourism. So it's been pretty fascinating to sort of see the varied pace of return to health, and indeed how these assets benchmark against the sort of city as a whole. So that's on the sort of the occupational demand side. As for the capital markets, for reasons outlined earlier, the demand continues to exist. And I'll reiterate that clearly we're in a market that favours those that have been there before, with local teams on the ground, including an asset management sort of capability, and accordingly those better suited to be able to navigate the nuances of the prevailing occupational markets. Back to you, Catherine.
Thank you, Gordon. I see more questions coming up, and I'd like to ask this question to Francis. So there is news that the Chinese government has given go-ahead for the setup of REITs in China. How will this affect the property market, especially in tier 1 cities like Shanghai, Beijing, and Shenzhen? Would you please share some insights with us?
Definitely, I think it's a good move, a right move for China government to consider the REIT, the true REIT vehicles to be launched in China. So we did see some of the managers, some of the investors start looking to buy more properties with rental incomes. But still, we have to wait for further announcement from relevant government on the detail of how to run their true property REIT in China, especially touching on the tax issues, because in the true REIT environment, you have to do the transfer of the property to the REIT vehicle. That will involve a kind of a transfer tax. And also in the REIT environment, we also concerned about the so-called double taxation, that on the REIT level and also the investor or the unit holders level. That I think those are very important. And on the manager, I think the real challenge is, as Gordon mentioned earlier, that the asset management capability is crucial to any REIT manager. So this is something we definitely like to see the further development with the industry on how to run a very good platform of say office portfolio, retail portfolio that's all a very rental generating assets in China.
Thank you very much, Francis. And the next question I'd like to ask Reid on Hong Kong. So any signs of companies moving away from Hong Kong as Asia headquarters? Will occupiers show preference towards certain areas like Central, Kowloon East, and Island East after the social unrest? Reid, would you like to answer that question? Thank you.
Sure. As of yet, we have not seen any cases of companies decamping from Hong Kong. I think for many companies, certainly the unrest that we saw in the latter months of last year was considered, again, a short-term event. Perhaps some had prepared contingency plans, but to our knowledge, there was no no movement. Within Hong Kong, certainly up to the COVID-19 outbreak, we were seeing a continuing decentralization trend, particularly away from the high-cost non-core areas, and that's really a trend that we've been seeing for the last few years. I think in the near term, over the next few months, we may see a slowdown of some of that activity as companies really focus on capital preservation and may choose to stay put for the time being. So we may see a little bit of a slowdown, at least in the near term of that, but would expect that to pick up again, certainly more in the mid to long term.
Thank you very much, Reid. The next question I'd like to ask Alvin. So on the presentation slides, we see there are huge office supply levels coming in China over the next 5 years. How should investors cope with the supply pressure? And do you think COVID-19 will have a long-term impact on the investment market?
Thank you, Kathleen. I think office supplies is not a big problem in Beijing and Guangzhou, although it is substantial. Having said that, investors are now more risk averse and want to avoid vacant properties. They will want to minimize leasing risk by acquiring mostly listed property in CBD area. I believe that this pandemic will be gone one day, like other serious pandemics have happened in human history. However, the responses from most countries to boost economies with fiscal and monetary policies will have long-term effects on asset prices. Therefore, I believe asset prices will inflate and yield compression will happen in the long run.
Thank you very much, Alvin. The next question, I'll go back to Gordon. So what about the alternative investment, as you mentioned earlier? Are there any emerging strongly from the implications of the COVID-19 situation that you're seeing right now?
We can't go through a capital markets presentation and Q&A without a discussion on the alternative sector. And if we look at this sector, it's now making up something like 20% of capital markets activity globally. Over half of that is represented by PRS, or private rental sector, residential for lease, build to rent, multifamily, depending upon what you call it in your own market. And if we look at APAC versus global in 2019, 24% of all activity was apartment related, 8% hotel, 3% senior housing and care. So a total of about 35%. In contrast, in Asia Pacific, while hotel was fairly similar at 9%, the apartment market only made up 3% and senior housing and care even less at 1%. Most of that 3% in the apartment market was concentrated, of course, in Japan, where there's an established apartment sector. So it's really against that backdrop that we should be looking at capital markets activity in the Greater China market. So in addition to, I guess, developers increasingly getting involved in this sector, sometimes at the behest of local and provincial government. We were talking earlier about REITs and quasi-REITs in China, so the potential suitability of the apartment sector for the creation of these new products. I guess we've also sort of seen collaborations like Macquarie coming together with Greystar and attracting global capital, as well as some more sort of project-specific examples. But of course, not all of these routes are favourable and indeed accessible to what I expect is predominantly an international audience on this call. But nonetheless, managers and the like have been able to sort of access this area, perhaps in more nuanced ways like JVs, repositioning of buildings, and potential sort of use adjustments. Alvin might be able to give a little bit more colour, but I believe we've got a number of those under mandate in cities like Shanghai at this time. The question mentioned COVID-19, and that, I guess, sort of brings to the fore cold storage, which I touched on very briefly earlier, with that sort of example from Chengdu, and then also sort of data centers. For the former, so cold storage, perhaps like to direct the audience to a recent publication that we've done. Let me get the title right: Looking Beyond COVID-19, Cold Storage Logistics, a Heating Market in China, which was published just last month in April. The key takeaways, I guess, from that is that as the demand by consumers for quality and higher standards escalate, whether or not that's fresh produce or medicine, then the need for that space, and specifically located space, grows. And I guess one of the key questions for investors at the time in this sector, and we've seen both approaches, is do you as the investor, the owner, incur that additional sort of capex and take, of course, then the enhanced rental stream that flows from that, or perhaps more so for existing buildings, leave that for tenants to install. For data centers, please join the queue. Regionally, a very hot topic. I'm quite sure that most of the audience have heard about it through other forums, if not from our own market reports. There's only been a couple of sites in Hong Kong that have traded from the government in the last 10 years, and we've seen a 5-fold increase in pricing, one in 2013, one in 2018. And then Hong Kong also enjoys a fairly effective waiver system that we've been able to take advantage of recently and trading transactions in the data center space. Obviously, sort of key issues for the developer, power, and through our investigations, a growing familiarization here in Hong Kong of which parts of the territory have appropriate power, and indeed in what timetable. Turning to mainland China, a revealing comment from one specialist on a recent call was the need for data storage close to where it is originated. So notwithstanding potential concerns around data protection and privacy, there is clearly a need, a demand that needs to be satisfied. It's therefore in China, in terms of accessing this sector, about finding that right customer to partner with, the right operational partner, or potentially even the entity level play, as some groups have done. Pass back to you, perhaps, Catherine.
Thank you very much, Gordon. I'd like to ask one final question to Francis. What's your opinion on the ongoing attractiveness of China as a destination for capital? Would you have any tips or advice for investors as do's and don'ts?
China is still growing annually at a rate of something like 6 or 6.5%. And of course, it slowed down from previous year that is 8 to 9%. But given its critical mass and become the world's second largest economy, so I think the growth story is still a very attractive theme for investing in China. Especially China is turning from the world's production house into a local consumption market. So we talk about local demand, we talk about the both in terms of retail and office space. So this is a very encouraging theme for investors to look into the China market. And also given the China is ahead of the curve in terms of COVID-19, and most of the Chinese cities are now reopened for business. For example, like ourselves, our Shanghai office is almost like 80–90% back to normal. Even in Beijing, which is still under tight control measures. So we are already like 50–60% back to normal in Beijing. So we're definitely seeing the property market is coming back in China. And also we did see investors traveling between maybe Shanghai, Beijing, Shenzhen, Guangzhou to take the opportunity to get more stuff done in the next half of this year. So the juice is, if you want to invest more in China, do find a right city, the right property, and also your right partner to invest together. If you don't have a partner or a local team on the ground yet, and then the don'ts, of course, don't miss out the China market. That's my advice.
Thank you very much, Francis. And with that, I think we have covered all questions being asked today. We will send out the presentation slides and the recording shortly after. Thank you very much for joining us today, and please stay tuned for our future webinars. If you're interested in hearing more about the mainland Chinese markets in detail, we will cover the Tier 1 cities, including Shanghai and Beijing, in our upcoming Chinese session next Tuesday. And we are planning to run another Q2 market sharing session in English, including a deep dive into Shanghai in the near future. We are committed to providing our clients on insights on what's next for capital markets. You may visit our website for our latest research and thought leadership, and our brokers around the region are interpreting the impact of COVID-19 on investment markets and are here to provide advice. Please feel free to reach out to any of the contacts on the slide on the screen, and please enjoy the rest of the day. Thank you.